Plunging oil prices have been taking their toll on stocks, too. It's not just about oil, but now the commodity has turned around as OPEC reportedly weighs that proposal we've been talking about to cut production by up to 1.4 million barrels a day. Sam Dunlap, senior portfolio manager at Angel Oak Capital Advisors, joins us now. Sam, welcome to the show. Great to have you here. What's been interesting, I think, is the way that stocks, the Dow in particular, has been trading in tandem with oil. Oil crashes yesterday. It brings the Dow down with it. I mean, I understand there are worries about global growth, but isn't some of these lower oil prices good for stocks and companies and certainly consumers coming into the holiday season?
Yeah, absolutely. The weaker oil prices are certainly a boon to the consumer. Cheaper prices at the pump always help consumer strength and confidence as we look ahead. But, the recent plunge that we've seen in crude, we think is more of a supply and demand dynamic, as your previous guest, highlighted, just a tremendous amount of supply in the face of potentially weaker production ahead. We also think the weakness in some of the commodities, and particularly stocks recently, could also be attributed to the recent dollar strength that we've seen. And it's really in the face of a Fed, as we learned last week, they continue to tighten. There's no hint of any type of slowdown in their tightening campaign, and that's not only on the front end, which is their target rate, but also in the quantitative tightening campaign as they slowly unwind their bond portfolio. The U.S. is really starting to stand out among the developed world for staying the course, I would say, from a tightening perspective.
Well, let's get back to oil here for a second, because one of the interesting things that's happened is companies, the big integrated majors like Exxon, Chevron, they are not falling as much as oil has fallen, down 2%. Will these stocks start to reflect what's going on in the oil market more concretely?
We think, again, this is more of a supply and demand dynamic. It's been a swift shift, as we've seen. We don't see any weakness in the economy, the broader U.S. economy. As we saw in 2015, where you saw a really notable drop in crude particularly, that was really driven, in our view, from a fear of a real slowdown in the U.S., a fear of real recession and weakness. But you're just not seeing that.
But isn't that what's going on here?
Yeah.
I mean, isn't this really a worry about global demand? Phil Flynn just said that he expects oil to finish the day higher. Do you expect stocks to finish the day higher? And does the fact that OPEC has turned around on this, does this mean the global economy is going to be okay?
Well, global economy, certainly there's some fears that you've seen a slowdown there, but the U.S. economy and the U.S. strength is really starting to stand out, and I think that's really the key. And again, as I highlighted earlier, as you've seen from a dollar strength perspective, that's really driven by a Fed that sees a very strong economy. It'll be really interesting to see what Chairman Powell says today when he speaks, at the Dallas Fed. He's speaking on U.S. and global economic issues. It'll be interesting if he points this out. But the U.S. economy is, let's face it, it's surging at this point. There's concern that it is late cycle, but the U.S. is really starting to stand out from a growth perspective.
Well,
and the
to
Fed
your
is certainly
point,
not
Sam,
changing.
I think there have been concerns with what Apple has been saying about handset sales. There have been a lot of U.S. companies looking forward, saying that their growth is slowing. So big debate out there in the market about what's really the fundamental, the actual economic growth going on. Sam, thanks for coming on today. Thanks for coming on. Great to see you.
Thanks for having me.